Picture this. You're standing in a room with the world's smartest money managers, central bank governors, and billionaire investors. They're all whispering about the same thing. Not Bitcoin, not tech stocks, not even gold. They're talking about silver. And here's what should terrify you. They're not just talking about it. They're quietly accumulating it at a pace we haven't seen in decades. Let me show you something that'll make your jaw drop. Right now, as I'm recording this, silver is trading at levels that have institutional traders salivating. But here's the kicker. The price you see on your screen, it's a lie. Well, not exactly a lie, but it's not telling you the full story. Because while the paper price of silver bounces around, something extraordinary is happening in the physical market, something that's about to create the most explosive price move in precious metals history. You see, there's a dirty little secret in the silver market that nobody wants to talk about. For 5 consecutive years, we've been in a supply deficit. Think about that for a second. 5 years. That means for 5 straight years, the world has consumed more silver than it's produced. We're talking about a cumulative deficit of over 800 million ounces. That's not a typo. 800 million ounces of silver have essentially vanished from available supply. Now, you might be thinking, okay, supply deficit, so what? Prices should go up, right? And you'd be correct. But here's where it gets interesting. Despite this massive deficit, despite industrial demand hitting all-time highs, despite every fundamental screaming buy, the price has been contained, managed, suppressed if you want to use that word. And that containment? It's about to break in spectacular fashion. Let me paint you a picture of what's really happening behind the scenes. Every single day, massive amounts of paper silver contracts trade on the COMEX. We're talking billions of dollars worth. But here's the thing. Less than 1% of those contracts ever result in physical delivery. It's a paper game. A casino where bets are placed on the price of silver, but actual silver rarely changes hands. It's like playing poker with monopoly money while the real cash sits in a vault somewhere else. But something's changing. The players at this table are starting to call the bluff. They're saying, you know what? I don't want your paper promises. I want the actual metal. And when that happens, when enough people stand for delivery, when enough investors demand physical instead of paper, the whole house of cards collapses. Here's a story that'll illustrate exactly what I'm talking about. Back in the early 1970s, silver was trading around $1.50 an ounce. Industrial demand was growing, but nothing crazy. Then the Hunt brothers, a couple of Texas oil billionaires, decided they wanted to corner the silver market. They started buying, and buying, and buying. Not paper contracts, physical silver. Actual bars sitting in actual vaults. By 1980, they'd accumulated over 100 million ounces. And you know what happened to the price? It went from $1.50 to $50 in less than a decade. That's a 3,233% gain. Now, I'm not saying we're going to see that exact scenario play out again, but I am saying that the dynamics today are even more explosive than they were back then, because the Hunt brothers were just 2 guys. Today, we've got entire nations, central banks, industrial giants, and millions of retail investors all competing for the same limited supply of physical silver. Let me break down exactly why this is happening right now. First, industrial demand. Silver isn't just a shiny metal that looks pretty. It's the most conductive element on Earth. It's in your phone, your computer, your car, your solar panels, your medical equipment. Every single electric vehicle uses between 25 to 50 grams of silver. Every solar panel uses about 20 grams. And here's the thing. We're in the middle of a massive green energy transition. Governments around the world have committed trillions of dollars to solar energy, electric vehicles, and grid infrastructure. All of it requires silver. The solar industry alone is projected to consume over 150 million ounces of silver annually within the next few years. That's nearly 15% of total global production. And it's not like we can just flip a switch and produce more silver. Mining is a long, expensive, capital-intensive process. It takes years to bring a new mine online. And even then, most silver isn't even mined as a primary product. About 70% of silver production comes as a byproduct of mining other metals like copper, lead, and zinc. So if those metals aren't profitable to mine, silver production drops too. But wait, there's more. And this is where it gets really interesting. Remember how I mentioned central banks? Well, they're not just buying gold anymore. Several central banks and sovereign wealth funds have started accumulating silver. Why? Because they see what's coming. They understand that in a world where every major currency is being debased, where governments are printing money like it's going out of style, hard assets are the only real store of value. And silver? Silver is gold's scrappy little brother. It's got all the monetary properties of gold, but it's also got this massive industrial demand component that gold doesn't have. It's the perfect storm. Monetary demand plus industrial demand plus supply constraints equals, well, you do the math. Now, let me tell you about something that's happening right now that most people aren't paying attention to. The BRICS nations, Brazil, Russia, India, China, and South Africa, along with several new members, are actively working to create an alternative to the US dollar for international trade. And guess what they're using as backing? Gold and silver. They're not stupid. They know that a currency backed by actual commodities has real value, unlike the paper promises we've been living with since 1971. Speaking of 1971, let's talk about that for a second. That's when Nixon took the US dollar off the gold standard. Before that, dollars were redeemable for gold. After that, they were just paper backed by the full faith and credit of the US government. And what's happened since then? The dollar has lost over 98% of its purchasing power. That house your grandparents bought for $20,000? Now it costs $400,000. That's not because houses got better. It's because dollars got worse. And silver? Silver has been one of the few assets that's actually preserved wealth over that time period. Sure, it's volatile. Sure, it goes through boom and bust cycles. But over the long term, it's maintained its purchasing power in a way that paper currency simply cannot. Here's something else that's absolutely critical to understand. The silver market is tiny. I mean really, really tiny. The entire above-ground supply of investment-grade silver is worth maybe $50 billion. That's it. For context, that's less than the market cap of many individual tech companies. It's a rounding error in the global financial system, which means it doesn't take much money flowing into silver to move the price dramatically. Imagine if just 1% of the money sitting in global stock markets decided to move into physical silver. We're talking about trillions of dollars of potential buying power chasing a market worth billions. The price wouldn't just go up, it would explode. We'd see moves that would make the Hunt brothers squeeze look like a minor blip. And here's the thing. It's already starting to happen. Silver ETFs have been seeing massive inflows. Retail investors are buying physical silver at record rates. Coin dealers are reporting shortages. Premiums over spot price have been climbing. These are all signs that the physical market is tightening, that the gap between paper price and physical reality is widening. Let me tell you about what happened in early 2021. A group of retail investors on Reddit decided they wanted to squeeze the silver market. They called it #SilverSqueeze. And you know what happened? Within days, physical silver became almost impossible to find. Dealers sold out. Premiums skyrocketed. The US Mint had to ration silver eagles because they couldn't keep up with demand. And that was just a relatively small group of retail investors. Imagine what happens when institutional money really starts piling in. Now, I want to talk about something that's relevant to a lot of you watching this. If you're sitting on retirement accounts, IRAs, 401ks, you need to understand something. Those accounts are denominated in dollars. And as we've established, dollars are losing purchasing power every single day. Inflation isn't transitory. It's structural. It's baked into the system. The government has to keep printing money to service its debt. There's no way out of that trap without either massive inflation or default. And they're going to choose inflation every single time. Quick aside here, and this is important. If you've got $100,000 or more in retirement accounts, I've put together a comprehensive guide on how gold and silver IRAs actually work. It's completely free, links in the description below. It covers exactly how you can get physical precious metals into your retirement account without triggering tax penalties or early withdrawal fees. It's something I wish I'd known about years ago, because it's one of the few ways to actually protect your retirement savings from currency debasement while keeping all the tax advantages. Worth checking out if that's relevant to your situation. Anyway, back to what's about to happen with silver. Let's talk about the technical setup, because this is where things get really exciting for traders and investors. Silver has been consolidating in a range for months now. It's building energy, coiling like a spring. And when it breaks out, and it will break out, the move is going to be violent. Look at the chart. We've got a massive cup and handle formation forming over multiple years. We've got a golden cross on the moving averages. We've got momentum indicators turning positive. We've got volume increasing on up days and decreasing on down days. Every technical indicator is screaming that a major move is coming. But here's what's even more important than the technicals, the fundamentals. Because technicals can be wrong, charts can lie. But fundamentals? Fundamentals are reality. And the fundamental reality is that we have a massive supply deficit, surging industrial demand, increasing monetary demand, and a price that's been artificially suppressed for years. That's not a recipe for a modest price increase. That's a recipe for a moonshot. Let me give you some specific numbers to chew on. Global silver production is around 800 million ounces per year. Total demand is over 1 billion ounces. That's a 200 million ounce deficit annually. Now, some of that deficit is being filled by recycling and above-ground stocks, but those stocks are finite. They're being drawn down, and at some point, they run out. The Silver Institute, which tracks these things, estimates that at current consumption rates, we could see severe physical shortages within the next few years. Not might see, could see. That's a huge difference. Because once shortages hit, once industrial users start competing with investors for limited supply, the price discovery mechanism breaks down completely. We move from orderly markets to panic buying. And here's something that should terrify anyone who's short silver or holding paper contracts. The COMEX has a problem. A big problem. The amount of silver they have in registered vaults, meaning silver that's actually available for delivery, has been declining. Meanwhile, the number of open contracts has been increasing. That's a dangerous combination. It's like a bank that's promised to give cash to more people than it actually has in the vault. As long as everyone doesn't show up at the same time, it's fine. But the moment there's a run, the whole system collapses. We've already seen mini squeezes in the silver market. In 2008, during the financial crisis, silver briefly became almost impossible to source physically, even though the paper price was crashing. In 2011, when silver hit $49, there were massive delivery delays and shortages. In 2020, during the COVID panic, premiums on physical silver went through the roof. Each time the system came close to breaking. Each time it held together by a thread. But each time that thread gets thinner. Now let's talk about what smart money is doing. Because while retail investors are just starting to wake up to this opportunity, institutional players have been positioning for months. We're seeing massive accumulation in the silver mining stocks. We're seeing hedge funds taking large positions in silver futures. We're seeing family offices and high net worth individuals buying physical bars and storing them in private vaults. Why? Because they understand something that most people don't. Silver isn't just an investment, it's insurance. It's a hedge against everything that's broken in the financial system. It's a bet against central banks, against fiat currency, against the idea that governments can print unlimited money without consequences. And here's the beautiful thing about silver. It's accessible. Unlike gold, which costs over $2,000 an ounce, silver is still affordable for average investors. You can buy a 1-ounce silver coin for around $30. That means anyone can participate in this opportunity. You don't need to be wealthy. You don't need to be an accredited investor. You just need to understand what's happening and take action. But here's what you need to understand about timing. Markets can stay irrational longer than you can stay solvent. Just because the fundamentals are screaming buy doesn't mean the price is going to explode tomorrow. It might take months, it might take a year or two, but when it happens, when that spring finally releases, you want to be positioned before warning. Silver is about to do the unthinkable. Moonshot. Picture this. You're standing in a room with the world's smartest money managers, central bank governors, and billionaire investors. They're all whispering about the same thing. Not Bitcoin, not tech stocks, not even gold. They're talking about silver. And here's what should terrify you. They're not just talking about it. They're quietly accumulating it at a pace we haven't seen in decades. Let me show you something that'll make your jaw drop. Right now, as I'm recording this, silver is trading at levels that have institutional traders salivating. But here's the kicker. The price you're seeing on your screen, it's a lie. Well, not exactly a lie, but it's not telling you the full story. Because while the paper price of silver bounces around, something extraordinary is happening in the physical market. Something that's about to create the most explosive price move in precious metals history. You see, there's a dirty little secret in the silver market that nobody wants to talk about. For 5 consecutive years, we've been in a supply deficit. Think about that for a second. 5 years. That means for 5 straight years, the world has consumed more silver than it's produced. We're talking about a cumulative deficit of over 800 million ounces. That's not a typo. 800 million ounces of silver have essentially vanished from global inventories. Now you might be thinking, okay, so there's a shortage. Big deal. Prices will adjust. But here's where it gets absolutely wild. Despite this massive deficit, despite industrial demand hitting all-time highs, despite every fundamental screaming that silver should be trading at triple digits, the price has been remarkably contained. How is that possible? Well, buckle up, Because the answer to that question is about to make some very powerful people very uncomfortable. Let me take you back to a moment in history that's eerily similar to what we're seeing today. It's 1979. Silver is trading around $5 an ounce. Most people think it's just another commodity. But two brothers, the Hunt brothers, saw something different. They understood that silver was being artificially suppressed. They understood that industrial demand was exploding. They understood that the paper market was a house of cards, so they started accumulating. Not just futures contracts, physical silver, bars, coins, everything they could get their hands on. What happened next shocked the world. Within months, silver went from $5 to $50 an ounce. A 10 times move. Fortunes were made. Fortunes were lost. The entire commodities market was turned upside down. And here's the thing that should keep you up at night. The conditions today are exponentially more explosive than they were in 1979. Let me break down exactly what's happening right now, because this is where it gets really interesting. The silver market operates on two levels. There's the paper market, where banks and traders shuffle contracts back and forth, and there's the physical market, where real metal changes hands. For decades, these two markets moved in tandem, but something broke. The paper market and the physical market are now completely disconnected, and that disconnect is about to create the most violent price correction in commodity history. Here's what I mean. On the COMEX, the major futures exchange for silver, there are currently contracts representing over 900 million ounces of silver. That's the paper market. But here's the problem. There are only about 300 million ounces of actual physical silver backing those contracts. You see the issue? For every 3 ounces of paper silver being traded, there's only 1 ounce of real metal. It's a fractional reserve system, just like banking. And just like banking, it works perfectly fine. Until everyone wants their metal at the same time. And guess what? That's exactly what's starting to happen. Industrial users are getting nervous. They're seeing the supply deficits. They're watching inventories drain. They're hearing whispers about delivery delays. So they're doing something they've never done before. They're standing for delivery. They're saying, I don't want a cash settlement, I want my silver. And the exchanges are starting to sweat. But industrial demand is just the beginning of this story. Let me tell you about what's happening in the technology sector, because this is where silver goes from being a precious metal to being absolutely critical to modern civilization. Every single solar panel requires silver. Every electric vehicle requires significantly more silver than a traditional car. Every 5G tower, every AI data center, every smartphone, every computer chip, they all need silver. And we're not talking about tiny amounts, we're talking about industrial quantities that are growing exponentially. Here's a number that should blow your mind. Solar panel installations are projected to consume over 200 million ounces of silver annually within the next few years. That's nearly 20% of total global production. Just one sector, one use case, and it's growing at double-digit rates every single year. Now add in electric vehicles, which use up to 3 times more silver than traditional cars. Add in the AI revolution, which is driving unprecedented demand for semiconductors and data centers. Add in 5G infrastructure, which requires silver for its superior conductivity. You starting to see the picture? But here's where it gets even crazier. While industrial demand is exploding, mine production is actually declining. That's right, declining. Most people don't realize that silver isn't primarily mined for silver. About 70% of silver production comes as a byproduct of mining other metals like copper, lead, and zinc. So when those base metal mines slow down or shut down, silver production drops. And guess what's been happening? Base metal production has been constrained by everything from environmental regulations to declining ore grades to geopolitical instability. Let me paint you a picture of what's happening in the mining sector. There's a major silver mine in Mexico, one of the world's largest producers. A few years ago, it was producing over 20 million ounces annually. Today, production has dropped by nearly 30%. Why? Declining ore grades. The easy silver has been mined. What's left requires more energy, more processing, more cost to extract. And this isn't an isolated case. This is happening at mines around the world. The silver that's left in the ground is harder to get, more expensive to process, and less economically viable at current prices. Now here's where the story takes a turn that most analysts are completely missing. While industrial demand is soaring and mine supply is falling, there's a third factor that's about to light the fuse on this powder keg: investment demand. And I'm not talking about retail investors buying a few coins. I'm talking about institutional money, big money, smart money, the kind of money that moves markets. Central banks have been accumulating gold at record pace. Everyone knows that. But what most people don't know is that several central banks and sovereign wealth funds have started looking at silver. Why? Because silver offers something gold doesn't: industrial utility combined with monetary properties. It's a hedge against inflation, a hedge against currency debasement, and a critical industrial commodity all rolled into one. That's a combination that's incredibly rare in financial markets. And here's something that should make your ears perk up. The gold to silver ratio, which measures how many ounces of silver it takes to buy 1 ounce of gold, has been historically around 15 to 1. That means throughout most of human history, silver was worth about 1/15 the price of gold. Today, that ratio is sitting around 80 to 1. Silver is historically cheap compared to gold. Absurdly cheap. And when ratios get this out of whack, they don't gradually drift back to normal. They snap back violently. Let me tell you about what happened in 2011, because it's a perfect case study of what's about to happen again, except this time it's going to be much bigger. In 2011, silver went from around $18 an ounce to nearly $50 in a matter of months. What drove that move? A combination of factors: quantitative easing, currency concerns, and a surge in investment demand. But here's the key difference between then and now. In 2011, we weren't in a structural supply deficit. Industrial demand wasn't at all-time highs. The paper market wasn't as stretched. The conditions today are exponentially more explosive. Think about the macroeconomic backdrop we're living in right now. Government debt levels are at all-time highs. Central banks have printed more money in the last few years than in the previous century combined. Inflation, despite what official numbers say, is eating away at purchasing power. Geopolitical tensions are escalating. The dollar's dominance as the world's reserve currency is being challenged. And in this environment, where do you think smart money is going to flow? Here's something most people don't understand about silver. It's the most volatile of all precious metals. When gold moves 10%, silver typically moves 20% or 30%. It's leveraged to gold's movements, but it's also leveraged to industrial demand, to inflation expectations, to currency debasement fears. It's a coiled spring. And right now, that spring is compressed tighter than it's ever been. Let me share something with you that might be relevant to your situation. If you're sitting on retirement accounts, if you have significant savings in traditional assets, you need to understand something. The financial system is changing. The rules that worked for the last 40 years might not work for the next 40. And one of the ways sophisticated investors are adapting is by diversifying into hard assets. I put together a comprehensive guide on how gold IRAs work, how you can get physical precious metals into your retirement accounts without triggering tax penalties, and what you need to know before making any moves. It's completely free, and you'll find it in the description below. If you've got $100,000 or more in retirement savings, it's worth taking a look at. No pressure, just information that might be valuable for your situation. Now, let me get back to why silver is about to do something that's going to shock the financial world. There's a concept in markets called a squeeze. It happens when there's a mismatch between supply and demand, and that mismatch gets so extreme that prices have to adjust violently to bring things back into balance. We've seen squeezes in various markets over the years, but what's setting up in silver right now is the mother of all squeezes. Here's why. The paper market has created a massive short position in silver. Banks and traders have sold contracts representing hundreds of millions of ounces of silver that they don't actually have. They've done this for years, and it's worked because most contract holders settle in cash rather than demanding physical delivery. But what happens when that changes? What happens when industrial users start demanding delivery? What happens when investment funds start taking physical possession? What happens when the fractional reserve system in the silver market gets stress tested? I'll tell you what happens. Prices explode. Because when you have more claims on silver than actual silver exists, and people start demanding the real thing, the only way to resolve that imbalance is through price. Massive, violent, upward price movements. The kind of moves that create generational wealth for those positioned correctly, and devastating losses for those caught on the wrong side. Let me give you a real-world example of what this looks like. A few years ago, there was a squeeze in the nickel market. Prices went from around $20,000 per ton to over $100,000 per ton in a matter of days. Trading had to be halted. Contracts had to be canceled. It was chaos. And that was in nickel, a market that's much larger and more liquid than silver. Now imagine what happens when a squeeze hits silver, a market that's relatively tiny, with massive short positions, declining supply, and exploding demand. But here's what really keeps me up at night, and what should concern anyone paying attention to financial markets. The silver market isn't just about silver. It's a canary in the coal mine for the entire financial system. Because if the paper-silver market breaks, if the fractional reserve system in commodities gets exposed, it raises serious questions about other markets. How many other markets are operating on similar principles? How many other assets have more paper claims than physical backing? And what happens when confidence in paper assets starts to erode?